Good morning and welcome. Patriot Radio News Hour. I'm Joe Jaquint, CEO of the Patriot Trading Group, and our toll-free number, 800-951-0592. The website at allamericangold.com. And welcome to, Tuesday. Yes, Tuesday the 25th. We are now 8 days away from another Fed rate hike, and we've got major intervention in the markets again today. Japan trying to hold on. China comes out and sets the renminbi at the lowest levels in 14 years, as again, a currency crisis really unfolding globally. It's the story nobody wants to talk about. But, Jason, it is creating a lot of problems in the bond market.
Yes, Joe. The bonds. The currencies of the world are showing their weakness day after day after day. You talked about Japan yesterday. How they just do everything they can to fix it, and it just gets worse and worse and worse. And so, Joe, who's going to buy them? I wouldn't buy them. I mean, who wants those things until they pull some magic trick? I guess, right?
Well, that's what they're going to need, a magic trick for sure.
Yeah, a magic trick to try to fix the bond market that nobody seems to want to buy any, and they have these auctions, Joe. Nobody seems to want this stuff, They have to somehow be tempted into it. But as time goes on, Joe, as we see them raise the interest rates, talk about the Federal Reserve, we'll see. We'll see how bad it gets. We're going to start hearing about, are we going to hear that nobody's buying U.S. Treasuries at some of these auctions? I think we are.
Boy, I hope that's not the case. And again, though, I know this. Janet Yellen, the Treasury Department, is working on something. They haven't given a lot of details, but Jason, that's what they're worried about. They're worried about the market seizing up. Where in America, got to remember now, this is the digital age. So if you end up with a moment, it may be 5 seconds, it may be 2 seconds, where there isn't enough buyers for the supply. Jason, you get these huge spikes in a matter of seconds.
That is correct. And then what you'll start to see is everybody, if it gets bad enough, Joe, this is what creates those big market crashes when people feel like their flight to safety is no longer safe. Then you start to see things really explode. That's why I'm wondering, Joe, if this is kind of a timed event. Are we going to see this sort of thing happen right after these midterms and really see things go really badly?
Yeah, and again, so we'll have to keep our eye. So let me break down what's happening right now. We've got gold higher, silver higher. The Dow is up, not because news is great. The bonds, the yields falling on bonds all over the world, with the exception of Japan. But right now, our 10-year note, which was almost approaching 4.5%, is at 4.07. And this is a big problem. Like I said, 8 days from now, our Fed's funds rate is going to be just under 4%. So we're back in that territory. This is probably going back 2 or 3 rate hikes ago, where we were speculating, could it be possible that we could get a 10-year note yielding less than the Fed's funds rate?
That's very anything is possible, Joe, when it comes to the economic system that we have to live under. So we'll see, Joe. We'll see. I believe the rate hikes will continue on. I was listening to some guys last night talk about that. This one guy, he's convinced the February rate hike is absolutely going to happen in February, and he was saying, the inflation, Joe. I'm thinking the inflation is not fixed next year. I don't think we're going to see the CPI and the other indicators drop significantly or even stay the same. I think we see it go up next year or later this year, which means they're going to have to continually rate hike into next year, maybe deep in the next year, Joe. And that's going to cause the bonds to be even worse, right?
Yeah, and again, as we're and Jack, yeah, I did have a mic on, so hopefully I'm sounding a little.
It sounds
better.
Great now, Joe. Sounds great.
Okay, all right. So diesel supplies. We got to talk about this. The diesel supplies, multi-year lows. We're talking about inventory levels 20 to 25% below where they need to be. Gasoline inventories. We've got the same problem there. In a weird way, listen to this, though. Some natural gas prices, especially in Texas, are now heading towards zero, and not the natural gas prices you guys pay or we pay, because we've got pipeline problems. Some pipelines, there's some maintenance, and all of a sudden these guys that are producing this natural gas, Jason, they got nowhere to go with it, nowhere to store it. We're getting awfully close to where they may have to pay somebody to take their natural gas from them. This is how crazy these markets are right now.
Yeah, that doesn't sound good at all, Joe. I mean, things are every indication is that we are in a depression now, as far as I'm concerned, Joe. We'll talk about it a little bit maybe later in the show, but if you really look at what's gone on since coronavirus, it sure smells and seems a lot like there's nothing going up. Nothing's really improving. There's nothing being actually fixed. But there's a whole lot in the media just telling everyone everything's okay. You know, have you seen that, Joe? Everything's okay. You're right. Everything is okay. They just keep pushing that. Go watch your sports, right, Joe? Just take it easy. Everything's fine, right?
Yeah, don't pay attention. You better start paying attention when we get back. We've got a neat little sale that I think you're going to like. And then Stanley Drunkenmiller. This is a guy that I tell all of you need to pay attention to. Starting to sound like Jason. Yeah, I know. Scary, right? We'll be right back. 800-951-0592. Patriot Radio News Hour. Gold's up 7 here, 16.57. Silver's now 19.25 and rising as, again, we have bond yields falling, which really, to me, probably indicates a couple of things. Number one, there is a bunch of buying in the bond markets today because I think people are looking at this Wall Street rally as nothing more than one of the, what do they call it? Dead cat bounces, whatever you want, bear market rally, whatever you want to call it. But again, it's getting awfully interesting because we're trying to decide, listen, we know they're going to raise rates till they break it. I mean, that's a given. Right? I don't think anybody out there sees it any other way. There was some wishful thinking, right? There was some ifs and buts and candies and nuts and all the other stuff, those mythical unicorns, right, where somehow they could just raise rates just enough that miraculously inflation would go away and everything would be wonderful. And again, that was bad logic. That was just as idiotic as saying inflation was transitory. And I know, listen, they've got to say it, but everyone should be getting prepared. And I've prayed on this, and I've asked God to try to give me the right words. Because it's really hard to emphasize how small of a window we have. We've got a rate hike in 8 days. From that moment, I give us less than 6 months. That's just where I think I was saying October. It's probably going to be November, because the Biden administration pulled off enough tricks to get through the midterms. November's going to be ugly, but the problem is, to Jason's point, we're getting more rate hikes. We're getting rate hikes in December. We're getting rate hikes in February. We're getting rate hikes in March, and this is going to get ugly. You need to get ready, and you need to do it now. Here's the realities. I know you're like, but gold and silver, they're not doing anything. But they are. See, that's the problem. They're not doing anything on the paper price. Physically, they're doing all kinds of things. Stockpiles have never been lower, right? And again, why is it not doing great on the paper price? Well, they still want to believe in unicorns, and that's okay, right? Fairy tale creatures, right? Who doesn't like that, right? We love fairy tale creatures. We love unicorns. We love to believe, but you got to prepare for the reality. And that's what the big money is doing. Silver premiums, another all-time record high today. Jason, it's almost never ending. Gold premiums right at all-time record highs, and it just isn't stopping. The buying isn't stopping.
Yeah, Joe. So the breaking, as you're saying, in November, when it starts to, and it's been broken. I think it's been broken since 2020. Actually, they've kind of painted over it. They've kind of papered over it and just sort of give you a story. But I think in November it gets worse, and I think it's bad all the way through 2023. I think we're going to see things we've never seen before. And people are in these markets, these people that think they're experts by looking at recent history, even the last 20 or 30 years, they're not going to believe what they're seeing. Because the Fed will do nothing but stop trying to attack inflation. They don't really exist as an organization if they don't show that they can take care of one of their mandates, which is, hey, we need to get rid of inflation. That's the most important thing. And Joe, I just see them, putting oil into the reserves after the election, shutting off more avenues to grow food, more avenues to create energy, and that's going to create just a bad situation. And I think their numbers they use, their indicators for jobs, I think it's working against them. I don't think they're going to see in their numbers what they need for job destruction until a very late point, just like transitory, Joe. It's going to take a year maybe for them to figure out, okay, yeah, now the jobs are destroyed. Now maybe we'll – and at that point, Joe, can they even switch? Can they even switch to stopping the rate hikes or trying to actually lower them and start printing if the inflation's, let's just say, 8 or 9% on the CPI? Can they do it?
Yeah. The big problem, food and energy. You just hit it right on the head. The energy problem's not going away. It's not going to go away for years. It's fundamentally broken. This rush to renewables and somehow convincing like J.P. Morgan and BlackRock and all these other guys not to invest in an oil and natural gas. I mean, that's going to go down in the history books as one of the dumbest things this country's probably ever done. The food situation continues to get worse, and you got to remember, think about farmers. What's their biggest cost, right? Well, fertilizer, fuel. Right? I mean, all of these are skyrocketing. Now, we just talked about diesel fuels at the lowest levels in decades. In the Atlantic region of the United States, do you know that gasoline supplies there are the lowest going back to 1993? And it's, you just think about it, it's a horrible situation to be in. And any little thing now sets these markets off. But again, listen, I'm already telling you that's a foregone conclusion. With Jason, this is a fact. This is what's going to happen. We're going to have a really bad 2023, really bad. The question that I'm talking about today, what comes after that? And you got to remember, we've had a history going back, really going back to, let's just say, the early 80s, right? Because the late 70s, right, we had the inflation problem, right? The oil crisis, the inflation problem. But ever since the 80s, in the early 80s, any problem has been met with throw money at it. That's not going to happen this time. And I'm sorry, because I know that a lot of people wish, because they're like, well, this is what the Fed always does, right? The Fed will stop, and then they'll just start lowering the rates again. We'll go back to zero. You can't do that if inflation is 6, 7, 8, 9, 10%. Stanley Druckenmiller comes out, and he's talking about the problem for the central banks and really said, hey, we're at the end of what he called the benefits of globalization. Because, right, one of the things, how did we get this debt to be this big? Well, part of it is we had to give a lot of stuff away, right? We had to give away manufacturing. We had to essentially build China into a superpower, because that's what we did by giving it all away. And now, Jason, that's kind of come to an end. So what he's saying is, get ready for a decade-long, no-return environment. So think about, when you think about the stock market, right, and 401ks, you think about, hey, I'm in my 50s, right? I'm going to retire at 65. Well, Stan Druckenmiller's kind of letting you know, no, you're not. Because whatever your 401k's got in it today, that may be what's in it 10 years from now. I'm going to give you my son's number again. I'm telling you, 602-909-9048. He goes, when I look back at the bull market, he goes, you really have to go back to 1982 when looking at the financial assets. All the factors that created that boom. And really, in my opinion, there's only one factor, debt creation. All the factors that created that boom have now been stopped. Matter of fact, they're reversing. And Jason, I think that's exactly what we're seeing here. Right now, our central bank, every major central bank in the world is now losing money on all the bonds that they've been buying. It's another factor that we haven't factored into the debt equation as well. But, Jason, all of that loose money policy has come to an end and is now reversing. And now we're talking about what? Hey, you know what? We can't rely on the rest of the world to ship stuff. We need to start building stuff back here. We almost got to go back to the deglobalization.
Well, I think what he said, globalization coming to kind of an end of a cycle, I think is pretty accurate, because in a lot of ways, since the 90s, America has kind of been floating off the GDP of China. They're building things, and their economy grows every single year at these huge amounts, and we get it cheap. If you can buy everything super cheap, if you got the deal where, hey, we gave it to you, now you have to give it to us for cheap. Well, once again, that's only going to last so long, because what we're doing, we're selling treasuries, we're selling debt. We sell dollars and we sell military, and they're actually manufacturing the products. Well, I don't think China, Joe, is reporting their economic numbers honestly. I think they're in a bad recession, really bad. And the rest of the world is not going to do better until China gets back up and starts performing again. And their housing market looks worse than the one we had in 2008. It's going to obliterate the economy. This is where we're sitting. Where I've said a few times, I keep comparing where we're at to 1968 and 1929, when the markets went down and didn't come back for 25 and 27 years. That's where we're at, Joe.
I'm just going to tell you this right now. And I'm looking at the research going behind all of this. The period of 1966 to 1982, the stock market did nothing.
Nothing.
And Druckenmiller saying, listen, get ready for nothing again. Let me just break down what we're looking at as far as the composition. We'll talk about the S&P 500. Okay. So here's where the growth of the S&P 500 has been. Going back to the bottom, okay? So got to go back to 2011. Only 31% of the growth. Remember, the Dow went from like 6,700 to 37,000, right? The S&P went from, I don't know exactly where the S&P was at the time, 3,400 to 4,700, right? Yep. Only 31% of that was from actual earnings. 21% of the growth was from multiple expansion. In other words, hey, we just started paying more earnings per share wise, with the premium. That's like the premium, right? Where you're paying 20% more than what it's actually worth. 7% from dividends. And here's the big kicker. Over 40%, 40.5% of all the growth in the S&P 500 was from share buybacks. So when you really start looking at this, if we're headed to where we're headed, which we know we are, listen, the share buybacks will stop. And Jason, that's really the problem because earnings are falling, right? Which means, obviously, as the rates go higher, the multiples got to come down, right? Usually when we get into recessions, people stop paying dividends, and then all of a sudden there's no buybacks. This could be a very ugly fall, and then Druckenmiller says, listen, after the fall, expect 10 years of no growth.
Yeah, it could be longer than that, Joe. It could absolutely be longer than that. And really, the only way you can make money in the stock market in that situation is these huge mega conglomerate companies like Walmart's and Facebook's and those huge ones, because what, are you going to invest in some company that's barely making it or is on its way down or being bought up by one of these companies? There's going to be no stocks to buy, Joe.
800-951-0592. Yeah, Bloomberg's reporting Treasury Secretary Janet Yellen has now flagged the potential for buybacks of certain U.S. treasuries by the Treasury Department in order to provide a maneuver. I'll get it out. A maneuver to provide improved liquidity to the markets. Jason, and again, this is scary here because now we're talking about, hey, Japan intervenes, China intervenes, UK. Now we're intervening, and as these rates continue to go higher, really at the end of the day, there's just not going to be enough buyers out there.
So you're talking about the Treasury buying their own treasuries? Is that what I just heard?
That's what it seems like. I don't know how that would work.
That would be like you and I buy. That'd be like you and I buying.
I don't know where would that money come from? I guess we would have to create more debt.
Yeah.
To buy the debt that was already created that there's not enough buyers for. And again, it's a liquidity thing because it could be there's no buyers for 2 or 3 seconds. 5 seconds, 10 seconds, right? The longer. Look at it, Japan. They went over 3-4 days where no one traded a bond.
Yes. I'll have to watch this video. I watched it again, but the guy was talking about a new government agency just for this sort of situation. I'll have to watch it again, maybe send it to you, but basically saying there'd be a new government agency, kind of a clearinghouse, for treasuries. So just for that fact where nobody's buying it, it's just give the Treasury a balance sheet. That's what it sounds like, Joe.
Yeah. Well, and again, all of these things are the factors of what's coming. And like I said, the time horizon is very short. It's almost November. March is just around the corner, and you need to do it now. And again, I think we haven't even come close to seeing what the premiums are going to look like. I can all but guarantee you there's going to be a huge gold and silver rally the second the Fed cries uncle, and I think that occurs between now and March. And unfortunately, the premiums along with it are going to go as well, because where else are you going? When we just essentially give up and now our Treasury Department's created more debt to buy the debt, right? The Ponzi scheme's about over. And again, remember what the goal is going to be, digital currency. Right? So we got to do two things. We got to prepare, and then we got to prepare for that digital currency. Having that barterable material has really been the name of the game out there, and we're going to do something really. I think it's cool, it's interesting, and it's a great package. We have 70 of these packages. They're $1,000 a piece, and we only have 70 of them in this package. you're going to get a roll of dimes. So that's 50 silver dimes. Remember, our dimes, quarters, and half dollars were 90% silver all the way through 1964. Of course, then they took the silver out because, well, let's face it, right? Because the silver was so much more expensive. Now they find the cheapest slag metal they can find, and it's still too expensive. But you're going to get 50 silver dimes, a roll of silver quarters, so that's going to be 40 silver quarters, a roll of silver half dollars, so that's 20 half dollars, and then a half roll. That's going to be 10 American silver eagles. So when you think about it, you're going to have 50 dimes, 40 quarters, 20 half dollars, and 10 silver eagles. That's 120 silver coins in all. Jason, all of it for just $1,000.
A silver weight just shy of 35 ounces, if I got my math right. So I mean, that's not bad, Joe. No, wait a minute. It's 25 ounces. Just shy of 25 ounces of silver, Joe. So that's a good way to go. I mean, you get a whole bunch of different ways of having silver, because I know people love the dimes, and I know people love the silver eagles. And then I got a lot of customers who are asking about hey, I've been buying silver eagles, but should I get the utility silver, the constitutional silver? And same thing, I've been getting the constitutional silver. Should I get into some silver eagles? This kind of gives you a little bit of everything. Kind of just check it out and compare it.
A little bit of everything. Listen, it's almost 28 ounces of silver into here, and again, this is something where I think it's going to be very important. This is going to be a brand new market. I think that comes out of the digital currency here. Putting these into your portfolio certainly makes a lot of sense. And again, like I said, I've only got 70. I've got 2 lines open right now, 800-951 0592. Again, that's 50 silver dimes, 40 silver quarters, 20 silver half dollars, and 10 U.S. silver eagles. That is 120 silver coins, 120 barterable silver coins for $1,000 at 800-951 0592. And then on other news, we had the consumer sentiment survey. And again, this is not one of my favorite surveys, but Wall Street likes this one, and they liked the number because it was bad. There was a big drop in current conditions, and this is important. This is saying to people out there, how you feeling right now? And it was significantly worse. It was 150. It fell to 138. And then future expectations. Hey, how do you think you're going to feel 6 months from now? And this was the part that is getting a little bit creepy. Jason, that was 78. So that's a big gap, right? Hey, right now I'm okay. But you know what? 6 months from now, not looking good.
I don't think anything about the last 2 or 3 years of what's gone on in this country and the world gives anyone any confidence at all, Joe. So I totally get that. I mean, there's more despair in the feelings of what's going on here and in the future than there is optimism, for sure. And by the way, on that special, if you're one of those guys like, I don't really want a half roll of Silver Eagles, then just order 2 of them. You know, get your full roll of Silver Eagles, and you get 2 rolls of each of the.
Problem solved there, right? Absolutely.
So if you can only afford the one package, get one. But if you want the full roll of Silver Eagles, just order 2 of them. $2,000, right, Joe?
800-951-0592. Still got a line open. Get them while you can. We'll be right back. 800-951-0592. I guess the Silver Spectacular sale here. Get it while we've got it. And I mean that with all honesty. Get it while we have it. It's a roll of silver dimes, a roll of silver quarters, a roll of silver half dollars, and then a half roll of silver eagles. It's 120 coins in all. They're $1,000. And to Jason's point, if you want full rolls of silver eagles, buy 2, buy 4, buy 6, buy 8, however you want. But we only had 70. And listen, I've only got one line open, so they are going quickly. Get them while we have them. 800-951-0592. I hate to see this. Larry Summers. So Larry Summers, he was the former Treasury Secretary. So I want to say he was not Biden, Obama's Treasury Secretary, which Janet Yellen is now. In a warning to Bloomberg, he said that the Biden's big spending initiatives, including student loan forgiveness, infrastructure, right, that Inflation Reduction Plan, remember that one, is going to shake investor confidence. And here's what he said. If your deficit projections start to get out of control and your real interest rates start to rise rapidly, you get into a doom loop. And here's what he said. We're going to need to be watching our own fiscal projections in the United States very carefully. Now, here's what's interesting. They just reported that fiscal year 2022's deficit was only $1.38 trillion. Right, which was, hey, that's better than what it's been. Of course, I told you, add $1 trillion to that already. Right, we're already there. But here's something that I did not know that Summer points out. Just the first month of fiscal year 2023. That's the month we're in, by the way. The deficit for this month is projected to be 562% higher than the deficit from last year for the same month. 562%. And Jason, obviously I don't think every month's going to be 560% higher, but it's something where, again, I think very, very, very easily we could see deficits in 2023 that are above the deficits we saw during coronavirus, above $3 trillion. And again, this doom loop that Larry is talking about is, listen, all of a sudden, we're not paying 0.5% to borrow this money, right? We're paying 5, 6, 7%.
Yeah, Joe, the crash that happened in 2020, I've said many times, it should be looked at a lot more seriously. It just kind of came and went, and it was kind of accepted. Well, look at the emergency. Remember, in 2020, if you stubbed your foot, it was coronavirus's fault. Remember, everything was coronavirus's fault. And here we are in 2022. They're still going to blame some of these economic indicators on what happened in 2020. I mean, how long is that excuse going to last? And I think it's going to last for a couple more years. I think when we see blood in the streets, so to speak, in 2023, they're still going to point at coronavirus. It's such a convenient target to blame. And then you got a war in Ukraine, and maybe you'll get a war in Taiwan, and all kinds of other factors. They're not going to point at themselves, Joe. But this thing is what happened in 2020. All that money printing, all that massive amount that went into the people's hands, and look where we're at now, Joe. I mean, really, we're kind of in a depression. I mean, I remember just a few years ago, and I don't do late night stuff like I did when I was younger, but you know, remember you had the restaurants that were open 24 hours a day. You can just pull through the drive-through at like 2 in the morning and get something to eat. You know, Walmarts around where I live, Joe, you could walk in there 2 in the morning and go do some shopping. Things have contracted. Things have, with all that money they printed, to have this much contraction this quickly, Joe, shows a lot of stress. And this is why they have to raise the rates, because they wanted the inflation, Joe. I think they desperately needed the inflation because they're at the end of this phase economically. I think they know exactly what they're doing, Joe, and it's going to be a lot of pain and suffering. that 10 years of stagflation that you were talking about, it could easily be 15 or 20 years, but it's happening. It's going to happen, and people are going to have to get used to the new normal. Remember that? That was another thing a couple years ago. The new normal, right? That's all happening right now, Joe. They've told us.
And again, you start doing some math here. Social Security is going to cost another $140 billion with the COLA. Cost of living adjustment. Who knows? Medicare, Medicaid. Who knows how much more that's going to cost, right? So let's just call it $200 billion there. Interest on the debt is going to add probably close to another $400 billion in just a year. An additional spending just on interest payments on the debt. The Federal Reserve was remitting $100 billion. That's going to be zero. Well, they're going to be negative, but they don't have to pay it. Don't ask me why, but it's going to be zero. There's another $100 billion. Student loan forgiveness, right? Well, what number is that going to be? I don't know, $100 billion. Plus, not to mention all the other spending, because wait till this recession comes. You know what the government's going to do. They're going to come out and try to unleash a bunch of spending. And Jason, I'm just sitting here, and I was thinking we'd be in the mid, $2.5 trillion. Now I'm thinking, well, man, we could easily see a number way over $3 trillion, and then that starts to get scary.
Yeah, if you add the Fed's balance sheet, Joe, our debt should be much higher. So I guess we're not paying as much interest if it's on the Fed's balance sheet, right? Can you imagine? Just put all that in there.
Listen, here's the good news. I've got 3 lines open. The $1,000 Silver Spectacular, 120 silver coins for $1,000. 800-951-0592. Final segment coming up. 800-951-0592. The silver special today, and it is a great one. We've got 50 silver dimes. This is your utility or junk silver, pre-1964. You get a roll of 50 silver dimes. You get a roll of 40 silver quarters. You get a roll of half dollars. And by the way, the half dollars, you're saving $10 a roll. The quarters, you're saving $5 a roll. The dimes, you're saving $2.50 a roll. And then you're also going to get 10 silver eagles in there. The whole thing, Jason, 120 silver coins. It's only $1,000. That's it. At 800-951-0592. Right now we've got 2 lines open, so get your orders in. Get it put away. And again, this is really setting up. This is the package. First of all, silver's going to get it's already hard to get. It's going to get really hard to get next year. Really hard. Secondly, this is a really preparing for a digital currency where the government is going to limit lots of things. They're going to limit guns and ammunition. You know that. We all know that. Let's not kid ourselves. They're going to limit a lot of these carbon things. I think they're going to put limits on how much gasoline you can buy, how much, what temperature you can keep your house at. And by limits, I mean, you can have this much at this price, but if you go over it, right, it's going to cost exponentially more than that. And Jason, it really will be how much freedom you can afford at that point.
That's where the world is headed, Joe. We're going through a cycle where we're separating a lot more of the haves and have-nots, and there's a lot less haves than there are have-nots. We're creating a serf system, and monetarily and really, how smart are you? You got to figure it out. And one way to do it economically is make sure you have your assets outside of their system of what they control. And they control just about everything, Joe. So when you have something physically in your possession outside of what they do, it's a great, great way to protect yourself.
Listen to this number. 63% of Americans are now living paycheck to paycheck. That's incredible. 50% of the people earning at least $100,000 a year are living paycheck to paycheck. This is really what I would call the middle class on the brink, Jason.
Yeah. When you had the Dark Ages, when Rome fell up into the modern age, you had hundreds of years of the Dark Ages, which sounds really bad. Dark Ages, really, what it was is you had peasants and you had lords. That's all there was. You had the lord, the landlord. That's where that came from. And why was there castles? Well, because there was no Roman Empire to protect those northern European countries. So the lords would build a castle, and then the peasants would go into the castle and fight the battles against the Vikings off the coast or the German hordes that come in from the north. And it went on like that for hundreds of years. The peasants would go protect the lord's property, and then when the siege was over, they'd go back and have to rebuild all their own stuff. And there was no chance of you becoming a lord, Joe. This is a chance. You've got some time. We're not at the end of the Roman Empire, so to speak. There's a chance for you to build it, right, Joe?
800-951-0592. The 120 silver coins for $1,000. God bless everybody.